Hey everyone, and welcome to this deep dive where we're going to be looking at some of history's biggest stock market crashes.
Yeah, some of the most infamous ones for sure.
Exactly. And we're going to be using this YouTube video that breaks them down.
Yeah, it does it in a really clear way too.
Yeah, I was really impressed by it,
Me too.
especially for someone like me who's not, a Wall Street wizard or anything.
Right.
But the goal here is to really figure out what happened with these crashes.
Yeah, why they matter to us like today,
Right, why they're still relevant.
And how we can learn from them.
Yeah, so we don't repeat the same mistakes.
Exactly.
So just to give you a little taste of what we're going to be covering,
Okay.
we're going to start with the granddaddy of them all, the 1929 crash.
Oh yeah, the one that kicked off the Great Depression.
Exactly, the one that everyone thinks about when they hear stock market crash.
It's like the ultimate cautionary tale.
For sure. And then we'll move on to Black Monday in 1987, where the Dow Jones just tanked 22% in a single day.
Like, I don't know.
Yeah. And no one really knows why to this day.
It's still a mystery.
And then we'll talk about the dot-com bubble bursting in 2000.
Oh yeah, all that irrational exuberance.
It was crazy. And then the 2008 financial crisis.
Triggered by those risky subprime mortgages.
Right, which had like a ripple effect across the entire globe.
Yeah, it was a global financial earthquake.
And then we'll touch on the COVID-19 crash of 2020.
A reminder that even in the modern world, anything can happen.
Yeah, we're not immune to these kinds of shocks.
Not at all.
So let's rewind the clock back to 1929.
Back to the roaring 20s.
Yeah, when things were just booming.
The economy was roaring. The markets were soaring.
Everyone thought the good times would never end.
Yeah, there was this sense of invincibility almost.
And people were pouring their money into stocks.
Borrowing money even to buy even more.
They were buying on margin.
Yeah, which is basically like using borrowed money to amplify your bets.
So it's like a double-edged sword.
Exactly. It can magnify your gains if the market goes up.
But it can also magnify your losses if it goes down.
And in 1929, it went down big time.
And when the market started to dip, all those margin calls started coming in.
Yeah, demanding investors to put up more cash to cover their losses.
And it created this chain reaction.
Like a domino effect.
And it turned a small dip into a full-blown crash.
It was a panic.
But how bad did it actually get?
Well, the Dow Jones?
That's the big one everyone watches, right?
Yeah, it plummeted almost 90% from its peak in 1929.
90%? Are you serious?
Yeah, it took years to hit bottom.
That's insane. I mean, imagine losing like almost everything you invested.
Practically overnight.
It's hard to even fathom.
And it wasn't just a stock market problem either.
Right, it led to the Great Depression.
A decade of economic hardship.
That affected millions of people worldwide.
It was a global crisis.
So how long did it take for the market to recover from that?
Well, get this. It took a whopping 25 years for the Dow Jones to get back to its pre-crash levels.
25 years.
A quarter of a century.
So if you invested in 1929...
You wouldn't have broken even until 1954.
That's unbelievable.
It really highlights the long-term impact these crashes can have.
And why it's so important to understand risk as an investor.
Absolutely. You have to be prepared for the long haul.
So let's move on to a crash that might not be as well known as the 1929 one.
Okay.
But it still has some valuable lessons for us.
What are we talking about?
The crash of 1973-74, where the Dow Jones took a 45% hit.
Not as dramatic as 90%.
True, but still a significant drop.
And this one was influenced by some major global events.
Like what?
Well, for one, the Bretton Woods system collapsed.
Which was like the foundation of international finance since World War II.
Exactly. And that led to all sorts of currency chaos.
And then there was the oil crisis.
Which sent shockwaves through the global economy.
So the stock market was basically caught in the crossfire.
It couldn't escape the turmoil.
And during this time, we saw this thing called a dead cat bounce.
Yeah, it's not the most pleasant term.
But it basically describes this brief market rally that tricks people into thinking the worst is over.
It's like a false sense of hope.
Followed by another wave of decline.
It can be really misleading.
So what can we learn from this dead cat bounce phenomenon?
Well, it shows how market psychology can really mess with your decision-making.
Right. You might make emotional moves based on these short-term swings.
Instead of focusing on the long game.
So the key takeaway here is that global events can have a huge impact on your investments.
Absolutely.
And it highlights the importance of diversification.
Don't put all your eggs in one basket.
Right. And really consider those global factors when you're making investment decisions.
Think big picture.
Okay, so now let's talk about one of the most mysterious crashes in history.
Black Monday.
1987.
October 19th to be exact.
When the Dow Jones just plunged a record-breaking 22% in a single day.
It was a bloodbath.
And here's the crazy part. no one knows for sure what caused it.
It's still a puzzle.
There are theories, of course.
Some point to program trading.
Others to portfolio insurance strategies.
But the exact trigger remains a mystery.
So we have this massive drop.
And no definitive answer.
But what's interesting is that the market recovered relatively quickly compared to the 1929 crash.
Yeah, it bounced back much faster.
So what does that tell us?
Well, it shows that even after these huge shocks, the market can be resilient.
But the 1987 crash did raise some concerns.
About the growing influence of technology in the financial markets.
Right, all those computerized trading systems.
Now they're super efficient.
They can also amplify volatility.
Making those market swings even more extreme.
So it makes you wonder if all this technology is making the market more vulnerable.
It's a valid question.
Okay, let's shift gears now to the dot-com bubble of the late 90s and early 2000s.
Ah, the internet craze.
Everyone was so hyped about the internet.
It was the future.
And investors were throwing money at anything with the .com in its name.
Valuations were sky high.
But a lot of these companies had no profits.
No revenue even.
Sometimes just a flashy website.
It was pure speculation.
And the video we're using for this deep dive actually highlights some crazy examples of this .com frenzy.
Oh, yeah.
Like companies with no track record, no proven business model, suddenly becoming Wall Street darlings.
It was FOMO at its finest.
Fear of missing out.
People were chasing returns without really understanding the risks.
And when the bubble finally burst,
It was a rude awakening,
a lot of those high-flying .com companies came crashing down.
leaving investors with huge losses.
So what's the lesson here?
Well, it's a cautionary tale about speculative investing.
You have to do your homework.
Understand what you're investing in.
And don't get swept up in the hype.
It's easy to get caught up in the excitement, but you have to stay rational.
Right. You need a clear investment strategy.
Know your risk tolerance.
And don't let emotions drive your decisions.
That's key.
Okay, now let's move on to the 2008 financial crisis,
The big one.
triggered by the meltdown of the U.S. housing market.
Specifically, the subprime mortgage sector.
Could you break that down for us?
Sure, so subprime mortgages are basically loans given to borrowers with not so great credit scores.
Okay, so they're considered higher risk.
Exactly, and banks bundled these mortgages together into these complex financial products.
And sold them to investors all over the world.
It seemed like a good idea at the time.
But then housing prices started falling.
And defaults on those subprime mortgages skyrocketed.
It was like House of Cards.
And it brought down some of the biggest financial institutions in the world.
So it was this chain reaction that started with these risky mortgages.
And spread throughout the entire global financial system.
It's crazy how interconnected everything is.
It's a global village.
So how bad did the Dow Joneses get hit during this crisis?
It lost 54% of its value.
Ouch.
And the recovery wasn't uniform either.
What do you mean?
Well, the Dow Jones bounced back relatively quickly.
But other stock markets took much longer to recover.
Like the FTSE MIB in Italy.
So different parts of the world were affected differently.
Absolutely.
It makes you wonder about the role of regulations.
Right. Were there enough safeguards in place?
Did the lack of oversight contribute to the severity of the crisis?
These are important questions to consider.
And what lessons can we learn to prevent something like this from happening again?
That's the million-dollar question.
The 2008 crisis definitely exposed weaknesses in the system.
And it highlighted the need for more transparency and accountability.
Okay, so from the roaring 20s to the subprime mortgage meltdown,
We've covered a lot of ground,
it's like a crash course in financial history.
but hopefully one that leaves you with more knowledge than fear.
Exactly.
We can learn from these past mistakes.
And make better investment decisions in the future.
That's the goal.
So before we wrap up this part of our deep dive,
Okay.
let's talk about a more recent event.
One that's still fresh in our minds.
The COVID-19 pandemic crash of 2020.
Oh, yeah.
This one affected all of us,
In so many ways.
and the financial markets were no exception,
The pandemic was like an economic earthquake
triggering lockdowns, business closures,
and a wave of uncertainty.
and the stock market just went into free fall.
The Dow Jones experienced its fastest 30% decline ever
It was definitely a scary time.
for everyone.
But what's remarkable is how quickly the market rebounded.
It was a V-shaped recovery.
By the end of 2020, the Dow had climbed back to its pre-pandemic levels.
It was quite a turnaround.
But that rapid recovery was largely fueled by government intervention.
And massive stimulus packages.
Central banks around the world pumped trillions of dollars into the economy.
It was an unprecedented response.
And it seems like those interventions worked in the short term.
But the long-term consequences are still unknown.
It's like we might have just delayed the inevitable.
Or created new challenges down the road.
The massive amount of liquidity that was injected into the system could lead to inflation.
We've already seen asset prices surge in some sectors.
So the COVID-19 crash, like all the others, reminds us that the unexpected can and will happen.
We're not immune to these kinds of shocks.
So we need to be prepared, adaptable, and remember that investing is a marathon, not a sprint.
It's about the long game.
So from the roaring 20s to the subprime mortgage meltdown to the COVID-19 pandemic.
We've seen how market crashes can shake the world.
But they also offer valuable lessons.
About managing risk.
Understanding the interconnectedness of the global economy.
And the importance of having a plan.
So as we wrap up this part of our deep dive,
let's take a moment to reflect on what we've learned.
And how we can apply these lessons to our own investment journeys.
Because, as we've seen,
market crashes are a part of the cycle.
And understanding them is essential for success.
So stay tuned for part 2.
Where we'll delve even deeper
into the fascinating world of market crashes.
And explore strategies for navigating them.
Until next time.
Happy investing. It's kind of amazing when you think about it, how those crashes, even though they cause so much disruption, they can also lead to innovation and change.
Oh, totally. It's like that saying, what doesn't kill you makes you stronger.
Yeah, right?
Yeah.
Sometimes you need a big shakeup to clear the way for something new and better.
Like a forest fire clearing out the underbrush so new growth can flourish.
Exactly. And even the 2008 financial crisis, as bad as it was, it forced us to rethink the global financial system,
Yeah, like we had to rebuild the foundation to make it stronger.
Exactly.
Speaking of resilience, that brings us to the COVID-19 pandemic crash of 2020.
Oh, yeah, that one hit close to home for everyone.
We all watched as the markets just plummeted.
In response to that global health crisis
and the economic shutdown,
it was a shared experience.
It really impacted every aspect of our lives.
This crash was different, though.
How so?
It was so fast and fierce.
Yeah, it happened so quickly.
The Dow Jones plunged over 30% in just a few weeks.
Wow.
The fastest decline in its history.
But then it rebounded almost as quickly.
Yeah, by the end of the year, it had recovered to its pre-pandemic levels.
It was a V-shaped recovery.
Sharp and dramatic.
But we talked about how that was mainly due to those massive government interventions.
Right, all the stimulus packages.
And the trillions of dollars pumped into the economy by the Federal Reserve.
And other central banks around the world?
It was an unprecedented response.
Yeah, no one had ever seen anything like it.
And it seemed to work in the short term.
But we still don't know the long-term consequences.
It's like we might have just kicked the can down the road.
Yeah, we might be dealing with the repercussions for years to come.
It's like taking a painkiller for a headache.
You feel better in the moment.
But there could be side effects later on.
Exactly.
So the COVID-19 pandemic has definitely reshaped the world.
In so many ways.
And the financial markets are still adjusting.
There's a lot of uncertainty.
And volatility seems to be the new normal.
One of the big takeaways from looking at all these crashes is that the future is unpredictable.
Yeah, we can't control everything.
Black swan events, those highly improbable but high-impact events, can happen at any time.
They can come out of nowhere.
And shake up the entire financial system.
It's a reminder that risk is always present.
You can't eliminate it completely.
So if crashes are inevitable,
as history seems to suggest,
how can we invest in a way that mitigates that risk
while still allowing for potential growth?
It's like finding that balance between protecting what we have and reaching our financial goals.
That's the million-dollar question.
It really is.
There's no easy answer.
But it all starts with understanding your own risk tolerance.
Absolutely. How much volatility are you comfortable with?
What are your investment goals?
And what's your time horizon?
Once you know those things,
you can start building a portfolio that aligns with your needs and objectives.
It's like building a house.
You need a solid foundation
to withstand the storms.
You need the right materials and construction techniques,
so your house can weather the elements.
And diversification is key.
Don't put all your eggs in one basket.
Spread your investments across different asset classes, sectors, and geographic regions.
That way, if one investment takes a hit,
others can help offset those losses.
And we've seen from these crashes that certain asset classes perform better during times of uncertainty.
It's like gold.
It's often seen as a safe haven.
That can hold its value during market turmoil.
So having some gold in your portfolio might be a good strategy for more risk-averse investors.
People who want to preserve their capital.
But diversification isn't just about asset allocation.
It's also about spreading your risk across different investment styles and strategies.
So it's not just what you invest in,
but how you invest.
There's no one-size-fits-all approach.
Some investors prefer a passive approach,
tracking broad market indices through index funds or ETFs.
while others prefer a more active approach.
trying to outperform the market through stock picking or other strategies,
It's about finding what works best for you.
like choosing the right tool for the job,
You wouldn't use a hammer to tighten a screw.
or a screwdriver to pound in a nail.
Exactly.
So find an investment approach that you're comfortable with,
That aligns with your long-term goals.
and that lets you sleep soundly at night.
And don't be afraid to seek out advice from trusted sources.
Do your research
Understand the risks and potential rewards.
and make informed decisions.
That's where we come in.
We're here to provide our listeners with the knowledge and insights they need.
We're not financial advisors.
But we aim to be a valuable resource for anyone interested in learning more about investing,
Knowledge is power.
especially when it comes to your money.
And one of the most valuable things we can offer is historical context.
By studying these crashes, we can gain insights into how markets behave.
And develop strategies for navigating future volatility.
History may not repeat itself exactly,
But it often rhymes.
so by understanding the patterns and lessons of the past.
We can be better prepared for the future.
So as we wrap up our discussion of these 6 major crashes,
What's the key takeaway you want our listeners to remember?
well, market crashes are a normal part of the journey.
They're inevitable.
They could be scary and painful in the short term
But they also present opportunities
for those who are prepared.
and have a long-term perspective.
It's not about fearing crashes.
Or trying to avoid them completely.
It's about accepting them as part of the cycle.
And using that knowledge to make better decisions.
It's like studying a map before going on a hike,
You know, there will be hills and valleys along the way.
but you're prepared for them.
And you have a plan to reach your destination.
That's a great analogy.
Investing is a journey,
And there will be ups and downs,
but with the right mindset,
and a willingness to learn and adapt.
you can achieve your financial goals.
So let's continue our deep dive.
And explore some strategies for navigating these market crashes.
Stay tuned for part 3. All right, so we've really dug deep into these 6 major market crashes.
Yeah, we've covered a lot of ground.
And uncovered some really valuable lessons along the way.
I think so too.
But before we wrap up this deep dive, I
Okay.
want to leave our listeners with something to really think about.
Ooh, lay it on me.
So we talked about how market crashes are kind of like this recurring theme throughout history.
Right, they're not a matter of if but when.
Exactly.
Yeah.
So the question is, how can we as investors approach the market in a way that, mitigates risk, but still allows for that potential for growth?
Yeah, how do we find that sweet spot, that balance?
Right. Between protecting what we have.
And building towards those financial goals.
That's the big question, isn't it?
It is, and there's no one-size-fits-all answer.
Right.
But I think it starts with really understanding how much risk you're personally comfortable with.
Your risk tolerance.
Exactly, and then, building a diversified portfolio.
Don't put all your eggs in one basket.
Right, spread the risk, and then having that long-term perspective.
Yeah, not getting spooked by those short-term fluctuations.
Focusing on the long game.
It's like having a roadmap for your financial journey,
Oh, I like that.
where you want to go. You've packed a variety of supplies for the different terrains you might encounter
You're prepared for those detours.
and the unexpected weather.
Exactly, and the more you know about the landscape,
The better you can navigate it.
understanding your risk tolerance, diversifying, and thinking long-term, those are like your essential tools.
And don't forget about emotional intelligence.
Oh, that's huge.
Learning to manage those feelings of fear and greed,
Yeah, those knee-jerk reactions can really hurt you.
especially when the market's going crazy.
You gotta keep a cool head.
Stick to your plan.
Don't let your emotions make decisions for you.
The people who can do that are the ones who usually come out ahead.
In the long run, for sure.
So to our listeners, as we wrap up this deep dive into market crashes,
Yeah.
we want to challenge you to use this knowledge we've shared to become a more empowered investor.
Don't be afraid of those crashes.
See them as opportunities to learn
To prepare
and to refine your strategy.
and build that resilience.
Thanks for joining me on this deep dive.
It's been a blast.
It's been a fascinating look at market history.
And a reminder that even though crashes are inevitable,
They don't have to derail your financial journey.
the pleasure was all mine.
And to our listeners, thanks for diving in with us. We hope you found this episode insightful and empowering. And remember, knowledge is power. The more you learn about the markets, the better equipped you'll be to navigate those waves and ride the tide to financial success.